Welcome to my video blog, Questions of Doubt in Corporate Valuation. My name is Bernhard Schwetzler, and our today's question of doubt is there a difference between flow to equity, DCF models, and dividend discount models in corporate valuation? So let's start by having a look at the two, flow to equity and dividend discount model. So on the left-hand side here, you see the flow to equity model. It is the equity version of the DCF, discounted cash flow model. The entity version is well known as the WACC approach of DCF. So the idea is that you directly calculate the value of the firm's equity by discounting the future free cash flows to equity. And the discount rate here is the cost of equity of the firm. So on the other side, we have the dividend discount model, and here the idea is it's also an equity model. The idea is that the value of the firm's equity is equal to the present value of its projected future dividends. So you see here the discount rate is also the cost of equity of the firm, and here you see the future projected dividends of the firm. So in order to answer our question, we first look at the flow to equity model and the free cash flow to equity as its cash flow definition. So the free cash flow to equity can also be considered as being the so-called residual dividend. And the residual dividend is the dividend that the firm could afford to pay out to its shareholders after realizing all good investment opportunities that carry a positive net present value, and after having established the optimal debt level and the optimal capital structure. The idea is then, if there is money left over, it can no longer be invested into investments, in favorable investments, because the optimal investment program is already realized, and the money can also not be used to pay down debt because the firm is already on its optimal level of debt. And then the idea is the management of the firm cannot use the cash in order to further increase the value of the firm, so it should pay out this money into the pockets of the shareholder. So that's the basic idea. The free cash flow to equity is the residual. That is, this is the money left over after I have optimized my investment opportunities and optimized my debt level. So that is also reflected in our definition of the free cash flow to equity, as it is an equity model. It starts here in the earnings before taxes, then taxes and the net profit after taxes. And then you see that we go back making all these well-known adjustments for the investments. That is the net investment. We add back depreciation and deduct capex. That is here our net investment into the net working capital, the delta. And these two lines here reflect our optimization of our debt level. This is the change in the pension reserves, as can be seen as interest-bearing debt, and this is the change in the interest-bearing liabilities. So you see that our adjustments reflect these two optimization steps with respect to the investment opportunities and with respect to the capital structure and the debt level. So the free cash flow is then the potential dividend that the firm could afford to pay without deviating from its optimal investment and debt policy. So if the term dividend in the dividend discount model would be defined as the residual dividend, then of course there is no difference between the flow to equity and the dividend discount model. So then of course both are actually the same. And that of course begs for the question, that is, what if these two free cash flow to equity and projected dividend are not equal to each other? And of course, we can distinguish here two cases. And let's start with the first one. Let's presume that the future projected dividend exceeds the free cash flow to equity. And that means that on first glance, this projected dividend is too high. It's higher than the one that is yielding the optimal policy of the firm. So if the firm actually wants to pay out this amount, then of course you somehow have to find this additional money, that the difference between the realized and our residual dividend. You can do so by either taking on additional debt So finance your dividend by a credit. You can cut down investment, and by doing so, of course, get some funds. And you can use excess cash if the firm has excess cash on its own balance sheet. Yeah? Clearly, the options 1 and 2 are suboptimal and destroy corporate value because they depart from the optimal debt level, or they depart from the optimal investment scale. Yeah? You realize, of course, or you forgo some good investment opportunities just to realize the dividend. Yeah? Only the option number 3 is neutral. That is, if the firm uses excess cash in order to fund this additional dividend as the difference between the two, then it is value neutral. We will look at the conditions on the next slide. The second case is probably and obviously the more common one, that the projected future dividend is lower than the free cash flow to equity and the residual one. Yeah? That means the firm pays out a lower dividend. Yeah? So then, of course, the question arises, what shall the firm do with the difference between the free cash flow to equity and the dividend, that is, with this additional retained money? Yeah? So, and of course, this is the other side of the coin. Here we can either pay down debt, or we can make additional investments into fixed assets or into our working capital, or we can make investments into excess cash. Again, this is, of course, also the same token here. Down payment of debt and additional investments yields the firm realizing a suboptimal strategy. It departs either from its optimal debt level and destroys value, or it realizes bad investment opportunities carrying a negative net present value. Note that, of course, the definition of the free cash flow to equity implies that the capex and the delta net working capital are all carrying a positive net present value. Again, only the third option is neutral under certain conditions, if the firm invests the additional money on corporate level into excess cash. So, under certain assumptions, the projected future dividend is irrelevant for the corporate valuation. You can only rely, when valuing the equity, on the free cash flow to equity. And the reason is, if the firm departs from the residual dividend by either paying out more or paying out less, then this is value neutral, because the additional dividend that it gets in this case is compensated by an equivalent loss in value of the firm, or the loss in dividend by paying out a lower dividend than the residual one is exactly compensated by a corresponding capital gain that is exactly the same amount. Yeah? So in that sense, that yields the result that in corporate valuation, we don't have to care about the real dividend. We are only interested in the potential one, and the value of the firm is then driven by the potential one. Yeah? Whether the firm pays it out or not simply is a decision how to package this amount of free cash flow to equity into the two components: real dividend, projected future dividend, and capital gains in this case, which is the more common one. Yeah? So what is the assumption that is required in order to yield this irrelevance result? The assumption behind it is that, of course, excess cash carries a zero net present value. Or, put in other words, it earns exactly its cost of capital. Yeah? Why is this assumption necessary? Well, that yields exactly the result that either the additional gain in cash or the loss in cash is exactly offset by either a capital loss or a capital gain of exactly the same amount. Yeah? So let's look at this condition. Is it true that excess cash carries a zero net present value? If we assume a world without taxes, then actually this is true, because the beta of excess cash is equal to zero, and if it's close to riskless, that means that the risk-adjusted cost of capital is the riskless rate, and that means the firm's excess cash earns the riskless rate, and the cost of capital are also equal to the riskless rate, and that means that this requirement that cash has a zero net present value is met. Yeah? Things change if we introduce taxes. Yeah? So there are two different tax problems. The first one is the minor one. If we take personal income taxes and corporate taxes into account, then the personal income taxes yield the result that there is a wedge between the after-tax capital gains impact and the after-tax dividends impact. And the reason is that usually the effective tax rates on capital gains is lower than the effective tax rates on dividends, because investors can postpone the taxation. Usually capital gains are taxed when you sell your stock, yeah, and that of course is later compared to the tax dividend, and that yields this wedge between the two. Yeah. Thanks God, usually with one exception, the German CPAs, everybody calculates corporate values without personal income taxes. But the second problem arises also if we only take corporate taxes into account, yeah? And that is cash carries a negative tax shield, such as the opposite sign of the positive tax shield on debt. This comes from the fact that if the shareholders would hold the cash, so if you would pay it out, then the income that is generated by this cash, the interest income, would only be taxed with the personal income taxes, whereas if the firm holds cash, then it is taxed twice. If it cashes out and pays out the interest income as a dividend to the shareholder, once on the corporate level with the corporate tax rate, and then again additionally as a dividend on the personal level. And that means that cash can be tax-wise considered as being, in that sense, negative debt, and by doing so, of course, carrying a negative tax shield. Yeah. So, and that is a significant drawback. Yeah. But in most of the cases in corporate valuation, people ignore this. You could take this into account, for instance, in other approaches by calculating the tax shield only on the net debt position. Yeah. So, as I said, usually practitioners do not care too much about this restriction. Now, this slide is about to show you why it would be not a wise idea to directly discount projected future dividends instead of the free cash flow to equity as the residual dividend. Yeah? So, and that can be best highlighted by a simple example. So here we have a firm that has constant free cash flows to equity, and that, this is the standard case, has a projected dividend that is lower than the free cash flow to equity. And that means that the firm is setting aside a part of this free cash flow to equity and invests it into riskless assets or into cash. Yeah? So you see that every year the firm sets aside and retains 20 million euro, and you see that the cash balance is increasing from 20 million over the years to 120. Yeah? And so if you seriously want to use the dividend discount model, and you would have to take these additional dividends into account, then of course you would have to add this interest on the excess cash to the free cash flow, then perhaps also adjust it for the payout ratio. Then of course you have an increasing interest on the excess cash. Even if you would fully pay out this interest on the excess cash, there would be a significant problem. And the significant problem stems from the fact that this income here in the bottom line that is generated by cash is riskless. And that means then that you cannot simply add it to the free cash flow to equity up here, because if you do, then of course you mix and muddle up two cash flows of a different risk. And if you then want to discount the sum over the two, 100.04 or 100.08, you would have to adjust the cost of capital and the cost of equity. Why? Note that this, of course, the free cash flow to equity is driven by the firm's equity beta, and of course this additional cash flow here must carry a beta factor of 0. Yeah? And of course the firm's total beta is the weighted average over the two. And the problem is then, as our cash balance is increasing over time, you would have to adjust the total beta factor, the equity beta of the firm in every period. And by doing so, of course, you would have changing cost of equity in every period. Yeah? And that is, of course, an additional potential drawback, because that complicates the calculation significantly if you have different cost of capital in every period. Yeah? So instead of cashing out here our free cash flow to equity, that of course under certain circumstances can be done with a constant cost of equity as a discount rate. So here are some general videos on YouTube that I found that may be helpful for generally having a look into dividend policy or into the dividend discount model. You see here, this is a corporate finance online sessions of Aswat Damodaran with respect to this topic, the general dividend policy. One of my questions of doubt videos nicely explains the Gordon-Shapiro model and the link to the dividend discount model, taking the retention rate into account. And here, this is a nice model here of mergers and acquisitions, not inquisitions, acquisitions, breaking into Wall Street. The dividend discount model is widely used in the valuation of commercial banks, and this video is going to explain why this is the case. But actually, what this video is going to show is that it relates mainly, in my eyes, in my view, to the flow to equity model being used for bank valuation. That's it for today. Thank you.